Hey everyone, today I'm joined by Eric Goodman. He's the co-founder and managing partner of Goodman Capital. They're based in New York. We were talking about that right before we got on. They're a private equity firm specializing in real estate-backed private credit. If you don't know what that is, we're going to talk all about that today. I know I want to learn about it. He's the right person to talk to. Since he's been involved in real estate, he's built a firm that's sponsored funds for over 1,000 investors worldwide, and he's closed more than $1 billion in financing transactions. He's going to give us some insights on this whole world of private credit. We're going to talk about alternative investments and then how his team is navigating through all of the stuff that's going on in the market today. I'm excited to talk to him. Eric, how you doing?
Hey, Peter, thanks for having me. I'm really excited to be here today.
Give us a quick brief background on what is Goodman Capital, where are you guys today, and then we can talk all about this whole world of private credit.
Sure. Goodman Capital really traces its roots back to a firm that my family had built back in 1987. We were one of the first licensed mortgage brokerage and private lending firms back in New York State, just with Article 12D, the Banking Act, right when the industry was just starting to get regulated. And now you fast forward 38 years of effectively being in the same line of work, financing Class A housing across the greater Northeast, high barrier to entry markets, the same markets that are in our home backyard. The only thing that's really changed is as the markets have gentrified and improved and grown in volume, fast forward over $1 trillion of institutional capital flooding into the greater Northeast, the markets have really grown. And by utilizing really core concepts and principles and really honing down on those pillars of underwriting have allowed us to grow and scale in the way that we have over the last 4 decades. It's been a beautiful journey.
I mean, it's incredible what you guys have built over time. And again, it's a testament to, just building a great business. And I know it's a family-backed business. And you talk a lot about private lending. And I think for a lot of people, I think we hear those words, we understand what each of those words mean. But what does that mean in your world, just so I can understand?
Yeah. So actually, this whole world of private lending, I mean, now it's become in vogue. It's a household item. If you will, we were one of the originals in the private lending space, but it didn't used to have such a sound moniker. It used to actually be called shadow banking. That was the moniker that the institutional players cast on the non-banking sector to try and shun it of its participants and to dissuade borrowers from financing with alternative means. But private credit is really just the entirety of the segment of lending that's done through the non-bank sector and non-public lending sector. So, and private credit again is an often mischaracterized term. It applies to so many forms of lending. You can you have venture debt lending, you have business lending. This is all private credit, but we focus on one small segment of that, which is real estate-backed private lending.
So what kind of real estate or what kind of opportunities or what kind of people are actually borrowing money from you? Like what kind of deals are people doing?
So I'll tell you, if you kind of break it up into sections, if you will, you kind of have pre-GFC, Great Financial Crisis, kind of post-GFC, and then you have, if you will, post-March banking crisis, if you will. And if you kind of break apart those 3 segments, you kind of see a very different environment. So pre-Great Financial Crisis, you didn't have the regulatory environment like Dodd-Frank and Basel III and the banking regulation that came out of that crisis that basically cut banks out of the private lending business. I've been in the industry. I was working for my parents since I'm 10, 11 years old. You're going back over 25 plus years. And we would have rate sheets from First National Bank of Arizona, Countrywide, hundreds of banks that no longer exist today. Banks were in the private lending business. It would just be a typical bridge loan. So in that market, we were really financing more of the outer boroughs. So secondary and tertiary markets outside of Brooklyn, Queens, the greater Northeast. Now kind of fast forward from GFC forward, you start to see the bank pull back from that due to these regulatory constraints. And so as private lending starts to proliferate throughout the more primary markets like Manhattan and even on the edges, call it Harlem and Financial District and other parts of New Jersey, you start to see more and more inroads by the private lenders and our family. And then you go to March 23 banking crisis, and that was a game changer. The March 23 banking crisis, when we look back, will have been a seminal event that I think will change the face of private lending for the next 20 years forward, because it extinguished some of the largest commercial regional banks in the Northeast. I mean, you're not talking about lenders that were doing $1 billion, $2 billion. I mean, we're talking about a 30+ billion-dollar annual shortfall. You're talking Signature Bank, First Republic, Sterling, Dime, PIMD. We can name banks that, they didn't make the headlines in the New York Post, but they were the largest providers of capital here in the Northeast. And that fallout today has really driven the primacy of private lending to borrowers such as Class A developers, wealthy foreign nationals, wealthy domestic buyers who own and operate, portfolios of Class A housing. You're talking about some of the most wealthiest borrowers, developers, and our average borrower net worth profile in our portfolios are anywhere from 20 to 200 plus $1 million net worth profiles. This was a segment of the borrower profile that would just go to a private banking relationship, but that private banking relationship at First Republic no longer exists. So this seminal event, if you will, consequential, I think for the next 10, 20 plus years, hard to even imagine how it starts to turn, will really be an interesting time for private credit at its primacy.
So you've been part of that. And so talk a little bit about how that changed your company in terms of maybe what that looks like for you, and then how were investors able to kind of get access to different things as a result of everything that happened?
Well, I'll tell you, in the evolving interest rate environment that, again, the Fed put in place, right, we went from a very dovish to a very hawkish monetary policy, which effectively just means instead of a rate cut environment or a zero rate environment we saw in the post-COVID period, now we see a much more higher interest rate environment. And with the fallout of the retrenchment of some of the largest commercial banks, we're seeing, if you will, kind of a bifurcation in the opportunity set. So we see opportunities that borrowers who would have otherwise gone bank, but now those banks no longer exist. And those borrowers, they're great quality assets, but they just have no capital provider. And then you have those borrowers who may have gone non-bank private previously, and now they're being really impacted by the interest rate hikes. And so now those borrowers, instead of used to be borrowing at 12, are now borrowing at 14, 15. At Goodman Capital, we've made a very strategic pivot to play right in the middle of the fair field. We are not going to be lending and chasing those same high loan to value deals, the higher octane, higher risk deals that you could charge 14, 15%. Instead, we're chasing the bank deals. We're going after borrowers who would have gone to First Republic, Sterling, Signature, Dime, folks with very significant deposits, but have nowhere to park those deposits because those banks are out of business. And whereas they may have been willing to pay in previous years, a 7, 8% for bank money, today they'll pay 10, 11% for non-bank money. They can't get over, quite frankly, they're still adopting and normalizing this idea of paying double-digit rates, but the alternative is paying 14, 15. And so at Goodman Capital, we've really focused on the highest tier borrowers, the lowest loan to values, LTVs, ratio of the loan amount to property value. These are some of the safest investments you can play in private credit. Again, but it's all about risk adjusted. And so you just need to temper as an investor your approach, and ours as a lender. Hey, if we're going to be charging a 10, 11% return, we want to get the best quality collateral, Class A, new construction housing, not dated product. If it's rentals, it's commanding the highest rental rates, highest level of occupancy, with really sound financial backed borrowers. And that's how we've pivoted in this kind of wake, if you will, left born from the fallout of the March banking crisis.
Joining a mastermind group was a pivotal moment in my life. Within the first year, my income tripled, and by year 4, it had increased 20-fold. But the benefits went far beyond financial gains. I found myself surrounded by a network of like-minded individuals, forming connections that would become lifelong friendships. And the collective wisdom and support from this community played a crucial role in my success and personal development. From these amazing experiences, I felt a strong desire to create a similar community for my colleagues and peers, and that's you. That's why I launched Momentum MD Mastermind. People have been asking what this is. Momentum MD, or MMD for short, is designed to offer the same transformational powers in both personal and professional growth that I've experienced. It's not just about increasing your income. It's about creating this amazing environment where you can thrive, learn, and grow alongside other ambitious and supportive like-minded individuals. MMD provides a space where members can share their challenges, celebrate their victories, and push each other and keep each other accountable to reach new heights. It's about building a network of professionals who are committed to helping each other succeed. We focus on actionable strategies, accountability, and fostering an environment of continuous improvement. So whether you're looking to advance in your career, start a new venture, or simply find more balance and fulfillment in your life, MMD is here to support you every step of the way. Now, if this resonates with you in some way and you're interested in learning more, we'd love to hear from you. To learn more about the Momentum MD Mastermind and to pre-apply for a call with us, please visit MomentumMD.com. Let's see how we can help elevate your life to the next level. There are limited spots, so don't wait. Take the first step towards your transformation today. You won't regret it. I mean, let's talk about risk a little bit so people understand. So tell us how these work in general in terms of you're lending out money. Now, obviously, they're paying back. What kind of terms are people paying back in terms of like, are they paying you guys monthly, quarterly? Let's break it down to be really simple.
Yeah.
And then ultimately, what happens if they stop paying? So people can understand what that means. So that's kind of where the risk is. The risk in these deals is that whoever you lend money to, and I think everyone conceptually understands that, you lend money to somebody, they pay you back. And like a lot of people here, they have student loan debt and they have mortgages, so they're used to doing that and paying back debt. But what happens in your world and scenario? Like, where's the risk? And what happens if someone, for example, stops paying you? Like, what happens?
So I love that question. And I kind of want to tackle the second first, because when the borrower performs, it takes care of itself. I mean, just high level, let's give it one quick example. You have a borrower. She happened to acquire a townhouse on the Upper East Side. It's a mixed use townhouse, so apartments over a retail storefront, prime location off of Fifth Avenue in Manhattan. For those who haven't been to New York, many of us know Fifth Avenue. Great location right by the Metropolitan Museum of Art, one of the largest museums in the world. Very wealthy borrower. She happens to be a foreign national. Banking crisis comes and hits. She acquired the townhouse for $14 million all cash and is now looking for a post-closing refinance to pull some money out of that property. But as many of our borrowers do, they're not looking for high leverage. They want a low cash out refi. So that borrower came to us looking for a $6 million refinance on a property that they acquired for $14 million, which translates to about a 43% loan to value, just loan amount of 6 on a property value of 14. That borrower remits every monthly payment like clockwork, and that monthly payment that they make to us gets remitted to investors also on a monthly basis. When that loan comes due 12 months later, that borrower, because all of our financing is generally short term. We're in the short term bridge financing space. So we're typically financing borrowers in between a gap of time. Maybe they acquired it, but they haven't gotten their bank loan yet. They want to go to borrow from a bridge lender at pay a 10, 11% return. For 12 months, they go to a bank, lock it in for 7, 8%, and they hold it for 30 years. And so we're just plugging that gap. Now, that borrower makes every monthly payment, 12 months comes and goes. What happens if that borrower fails to secure a refinance and pay us off with the bank? The failure to repay the loan at that 12-month maturity triggers what we call maturity default. They default upon the loan maturity. Now, what I didn't share was the first 25 plus years of our business, we were solely focused on distressed debt, effectively investing and acquiring loans whose borrowers had defaulted on these exact scenarios. And so our team is built of 11 legal and investment professionals who are focused on underwriting assets, structuring loans, and then from closing through disposition, overseeing the servicing, so the constant remittance of borrower payments and by extension the distribution to investors, but also overseeing the loan workout and foreclosure process if and when a borrower defaults. Now, when you lend in New York is a judicial state. It means that if you're going to reclaim your underlying principal, you can't get to the county clerk steps in 90 days. You have to file a foreclosure action. And this applies in every judicial state across the country. You file a summons, a complaint, and it starts the legal process. Now, for having been in the business for 25 plus years, we can take a foreclosure from start to finish and actually recoup our principal within a 12 to 18 month window. We've done foreclosure and bankruptcy within about 16 months, which is unheard of. But we do it that quickly because our team is all in-house. We're not calling 5 law firms, hey, can you get back to me with a fee quote? They call you back 2 weeks later. No, the day a borrower defaults, 1 week later, if they don't make that payment current, we're sending them a notice of default, accelerating the loan, starting the foreclosure process. We are actively managing that process from start to finish. And that's the differentiator, how we're able to get our capital back. Now, investors who are interested in distress, these are higher levels of return, because the default interest rate that's accruing on that loan that you're going to earn is not going to be the 10, 11%. It will be a higher mid to high teen return. There's a whole analysis that gets done in that level, in that framework when you're investing in distressed debt. But to Peter, to your point earlier, which was so well said, really the first 25 years of experience investing in distressed debt is what informs how we structure, how we underwrite, the risk mitigation that we put in place day one, before we call investor capital to lend a dollar out to borrowers. And absent that experience of over decades of investing and overseeing a work on foreclosure, you really, as a lender, in my opinion, have no business being in the lending business because you don't know how to manage risk. So it was really that 25 plus years of experience that informs how we underwrite, which is a big testament to how we've been in business for 38 years. And not once have we lost a dollar of investor principal.
Got it. So again, I think we're starting to understand how this works. I mean, again, the investors essentially and through Goodman Capital, you guys act as a bank. You guys lend money out. That money gets paid monthly. Everyone's happy. If it doesn't, then there's this whole process of possibly foreclosure where you can go ahead and, go ahead and sell the asset. You get the money back and you're able to get your principal and your money back. And the good thing is, it sounds like is with these loans that you're not taking they're not high leverage loans. So meaning that they're relatively lower leverage. So that means that when they take it to market, they go ahead and sell this. There's plenty left over to pay back the loan. And perhaps there's even a little bit left over somewhere down the line. So, it's just trying to just understand the market of how this goes for you guys. And it sounds like you guys obviously understand how to deal with that process afterwards. And for anybody listening to this, it sounds like that's one of the questions you should be asking for any company that you're working with who's doing lending. It's not when things go right. It's like when things go wrong, how do you deal with that process? How do you deal with that? Now, that's a question that I've learned to ask over time. What are some of the other questions that somebody should be asking, like when they're actually going to do their due diligence on a company, especially when it deals with debt, notes, lending? Like, what are some of the questions that people should be asking that they typically don't ask?
So, great question. I can almost think of a compendium of questions I've heard from various clients over the years of mistakes they've made when they've invested in other lending firms and didn't know what to ask. So a few things. First thing I would ask is, how long have you even been in the lending business? Because private credit today is ubiquitous. Everyone seems to have a private credit shop, and they're in this business because of the secular and structural challenges, is what allows private lenders, when they know what they're doing, to charge a high rate of interest and ostensibly deliver a high rate of return. But that high level of return is a little too catchy, and it's a little too easily marketed. And so you want to make sure that your sponsor did not just get into the private lending industry in the last 3-4 years when rates were high. If they've only experienced private lending when rates were high and don't know how to manage downside risk when rates drop, or when borrowers default and now you have to oversee a workout and foreclosure, they really lack the professional fitness to be even in the industry at the outset, is my opinion. So find out how long they've been in the industry for, find out where they're lending, because there are judicial states, there are non-judicial states. If you have a lender who's only ever financed property in Texas, for example, they may think that there's an adjacent market that's as attractive. Or if you're in New York, you may think, well, New York has similarities to Texas. We're in the same country, but we're vastly different markets, vastly different asset classes, the asset value stability. The core of private lending is underwriting the underlying collateral. Because as an investor, how do you lose money? You lose money when you lend to a borrower, that borrower defaults, the sponsor or the lender takes over the property and sells it for less than your loan amount. That is a consequence of poor underwriting and poor financial discipline, because the collateral value is now worth less than the loan, and now your loan is underwater, and now you lose principal. So it's all about, we're all solving for is, what is the collateral value worth? Have we structured our loan at the right loan to value? Do we have a great quality borrower who has the financial means to manage and the experience to manage the property to preserve its value? And, and fundamentally, is the collateral value there? So understanding how long they've been in business for, are they shifting to different markets because maybe they've outgrown their strategy? We see a lot of times sponsors grow too quickly. And so it's helpful to understand their past track record. How big were they? What were they doing? What markets were they in? What kind of loans were they doing? Were they a senior lender? Are they doing mezzanine lending? Are they doing junior lending? Are they investing in subordinate and higher risk tiers of the debt stack that will now bring on risk when you now want to invest in them? And they're like, oh, I paid you 10, 11, now I'll give you 18, and you're investing in higher riskier tranches of the debt stack. That's something you have to be mindful of also. And then you have other questions just about transparency. Are they an audited shop? Do they have third-party fund administration? Is there someone overseeing the books and records? Understanding who's on the team. This is this is so foundational to understanding the performance of any sponsor. Rome wasn't built in a day, and you can't run a $1 billion shop with a one-man team. We have 11 investment legal professionals who've done this for 30 plus years. So you want to make sure you understand the quality and the caliber of the team that you're underlying investing in. Just a few things to keep in mind.
Okay. I think that's where it all starts. If people can, when they look for somebody, they talk to them, this across sponsors, these are all great questions. How long have they been around? What's their track record? Like you said, who's on the team? Who's running this thing? Because ultimately that's what matters. And I think that's great advice that you've given there. In today's market right now, I think there's a lot of, chatter about the market and interest rates now starting to perhaps, they've pivoted. The Fed has perhaps pivoted, and now it's starting to drop a little bit. For you guys, where do you see, if that's the market that we're headed in now, like, where do you see opportunity there for you guys? in terms of where the market is shifting and how it's going today?
I'll tell you, in the private lending industry, it's impacted by a few factors. Certainly, the overall interest rate environment is a big driver, right? As rates come in, it forces lenders to have to recalibrate where we're going to charge our borrowers. But keep in mind, the supply and availability of capital is at an all-time low, especially here in the Northeast, because while rates may come in, who's that next marginal lender of consequence that's going to eat your lunch and take your lending business and lend to your borrowers if the largest commercial banks are out of business? So banks fall out of business far faster than they reemerge. The regulatory environment is very onerous right now on banks. In fact, the regulatory environment is pushing banks, what we call, to move from residential and direct primary real estate lending into this category of lending called C&I, commercial and industrial lending. It's effectively lending to businesses. And so this pivot, and we see this and we hear this from all the chief investment officers of the local regional banks we work with, and we know most of them here in the Northeast. Banks are not looking to do more residential-based lending or housing-based lending. They're looking to lend to businesses, which is the traditional private credit model, as B2B, business-to-business lending. And so until there's this pivot away, interest rate decline alone is not going to change the opportunity set in the private lending business. You need competition, and competition is very hard to reemerge because there are just very few competitive private lenders that are operating at the scale that we're lending at. So a borrower comes to us, we're not closing a loan in 3 months. I'm closing business in 2-3 weeks. Our promise to our borrowers is that we'll deliver you speed of execution and certainty of closing. We can close a loan in 2 weeks, and we know we'll close it that quick because we've done it for decades before, but we do it so quickly for a few reasons. One, we're lending in our own backyard. Two, we have the in-house legal capabilities to issue term sheets, turn around loan docs in 72 hours. We're not waiting for other law firms to deliver docs and hand them over in 4 weeks. And three, there's just not a lot of competition right now because those who are playing at the, call it $5 to $50 million individual loan size, which is really where we dominate, that would have been a bank business model, but those banks have all retrenched. And so there's not a whole lot of competition in this below, lower to mid-market space that we're lending in. So until those other factors change, I think we'll see just a nice steady inflow of deals. We're seeing right now about $15 billion a year of origination pipeline. Again, we sort that. We're very diligent. So I'd say about 3 to 3.5% of that actually filters down into our pipeline. So anywhere from, call it, $350 to $500 million of deal volume is really a sweet spot for us given our size.
Oh, it's incredible. So when somebody comes to you as like an investor, usually, people are looking in our physician world, they're looking for different things, and people have different goals when they come in, they think about investing. What do you think the typical goals are for someone who invests in your world? Like, what are they looking for? What type of investor is probably the best fit for private lending and private credit?
So I'll give you the bookend. This is how I like to answer this question. My family bookends the youngest and the oldest investors. I have my children who are 3, 5, and 7. They invest in our funds. And I have my 95-year-old grandmother who invests in our funds. So I cover the age range. But I'll tell you, and I say that as a cute little vignette to start off that answer, because it's private credit, I think historically speaking, is thought of for a retiree, someone who's later on in their career. But the reality is, in today's environment, given the volatility in the market where we are, private credit, when structured correctly, is an excellent diversification tool. It's a way to reduce volatility because if you're lending as we do at sub 50% loan to values, we're mitigating principal risk at the highest level. So it's a great way to have a storehouse of value, but yet generate a monthly recurring income stream, low double digits. Whether you're a young professional and you're looking for something to supplement your income because you're in a high earning bracket and you may be in tech or a very volatile field and you want to have something a little more stable, or whether you're more seasoned in your career and maybe you sold a company and now you're just looking to generate something more stable and long-term income generative. I mean, you can really cover the range within private credit and tackle on and address many of the concerns that our clients have today, which is, hey, I'm so allocated to the stock market. There's been such a strong run up. I'm in crypto. I'm in private equity. I'm in credit. I'm in venture capital. But none of this is income generative. So much of this is back-ended. And so with so much uncertainty in the world, geopolitical risk, what have you, private credit is really a solution when structured correctly to provide a low-risk basis investment with a high, again, in today's market, a nice, double-digit return is a very strong risk-adjusted return for the level of risk that you're taking today.
That's awesome. Do you have any sort of advice, for investors as they're going into this world of private credit, alternative investments, maybe just a piece of advice just generally that you would have for somebody, whoever's listening to this.
So I'll tell you, in many of the investment groups that we're part of, in the circles that we see, one of the common themes I find that I try to really encourage members to be cognizant of is not to chase the high teen return in the private credit space or chasing returns at the while throwing caution to the wind. The reality is the only free lunch is in a mousetrap. So as a nice phrase that stuck with me over the decades. It's the objective of alternatives is to really match a commensurate level of return with the level of risk that you're taking. Now you can be tantalized by the high teen return, but don't let it fool you that you may be taking a lot of principal risk. And so if you do enough 15, 18% type deals, you will eventually start to lose principal, because that's just not where the private credit market is. It is one of the highest risk adjusted returning investments today. But if you think where it was, 7-8 years ago, ground up construction, speculative lending banks were charging 7-8%. So today, the fact that you can lend at a 50 loan to value, better than a bank, lower loan to value than a bank would originate on a class A piece of housing, piece of property, multifamily, mixed use, cash flowing, you have real collateral value stability. You're very confident that if the underlying property values of the markets take a bit of a hit, your every dollar of principal is protected. With that level of certainty to earn a 10-11% return today's environment, that's an extraordinary risk-adjusted return relative to where returns have been historically, not just 2-3 years, but 5, 10, 15, 20 years in the private lending space. So you have to have perspective and don't chase the shiny object. Be really dutiful and diligent about understanding where the risk parameters are. And if you're really looking at that level of low risk, it's going to come with a commensurate level of return, which today will be very high. And that's where you want to be locking in my opinion. You want to be locking in a lot of your capital in something very super low risk, income generative, tax efficient if possible, something that can generate you income for the next 3 to 4 years while the markets remain volatile.
That's awesome. I know people are going to hear this and they're going to want to reach out to you, connect with you in some way. Where's a great place for people to do that?
They can reach out to us through our website, goodmancapitalllc.com, to join our list. They can reach out to our team at invest@goodmancapitalllc.com. And I would love to answer any follow-up questions the community may have.
Well, this has been awesome. I know I've learned a ton about private credit, what to look for in this space, what questions to ask. I know that everyone, in terms of listening to this as well, has got value from this as well. So I want to thank you for your time. Keep up the amazing work, and let's talk again soon.
Thanks so much, Peter. Look forward to being in touch.
All right, thanks. Bye.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.